Ladies and gentlemen, you are now watching and listening to Real Talk with Ronnie with your host, Ronald Lynn. All right. Good evening, ladies and gentlemen. Welcome back to Real Talk with Ronnie. My name is Ronald Lynn, your host. You can check us out at realtalkronnie.com. So we're back for another great episode. Last week, something very big happened, right? We had a very big financial crisis here in the U.S. in the form of Silicon Valley Bank crashing, right? Now, Silicon Valley Bank, I think most of its deposits are from smaller companies, right? From entrepreneurs. So the fact that a bank like that has crashed has big repercussions to a lot of people. And here to discuss this issue and to try to explain to the general audience what exactly happened are two friends of mine who work in the banking and finance sectors. The first person I will bring up is Alexandra Black. She is currently out in the West Coast for some business. And the second person on my panel tonight is Richard Garcia, who is the president and CEO of Union City's credit union. Okay, so these are both big honchos in the banking world, and we're very happy to have them on our show tonight to explain to us lay people, what exactly happened. All right, so let me bring them on. All right, so the first person on our panel is Alex Black. So Alex, why don't you give us a little rundown on what you do and your thoughts on this entire SVB crisis?
Absolutely. So I've worked in capital markets my entire career, mostly on the investment management side, helping investors, both institutional and retail, navigate themselves around investing their portfolios. It's definitely unique to have a view on something like this going on because it does get a little bit political, which you try and avoid in your everyday career. But we are mostly in this crisis due to the Fed, which some argue is unconstitutional, but many rightly argue has made quite a few poor decisions in actually for a very long time. One of the worst things was the period of time that we were at zero rates. It drove the entire market, including individuals, towards taking larger risks because everyone needed a return on their capital. And it was the same for banks, even though they are restricted by certain capital holding requirements and what risks they're allowed to take with deposits. One of these safe spaces that they're supposed to be able to keep their money is US Treasuries. Now, with how fast these rate hikes have happened, and they honestly should have started in kind of the summer of 2021 when inflation first kind of showed that it was happening and everyone said that it was transitory, that was associated with the Fed or was political, even though anyone economics oriented or market oriented would tell you it absolutely was not transitory. They would have been able to, over time, have much smaller rate hikes. These rate hikes have been unprecedented in size and speed, actually resulting in the largest decline in value in US Treasuries in almost a century, which is absolutely crazy. So SVB definitely took risk, and they knew it was risk when they put a significant amount of their portfolio into long-term US Treasuries. When you put the fast rate hikes, and then you put the fact that tech has been suffering, these small companies have been suffering, they needed more of their money. SVB has always been a tech business oriented group. They needed their deposits. They started pulling money. It started to show stress on the bank. Word obviously spread, which started a bit of a run, and that led to the collapse.
Okay, great. Thanks for that synopsis, right? For us lay people. Well, you guys are not lay people. I mean, just me, right? So I can understand the situation better. All right. Next up, we got Rich Garcia. Rich, why don't you give us a little rundown on who you are and any thoughts you'd like to add on this SVB? crisis?
Well, thank you, Ron. Alex, it's nice to be here with you. My name is Richard Garcia. I'm the president and chief executive officer of a credit union here in New Jersey called United Cities Credit Union. We've been around for 87 years, predominantly a consumer-oriented financial institution, very different from SVB Bank. And I agree with Alex that it's a combination of investments, their investment portfolio being long and low rates, inflation going up rather quickly, and as everybody knows, SVB Bank by now, most of their customers, most of their members, most of their customers were venture capitalist firms, and they needed their cash, and this happened very quickly. And that's one thing. And number two is, the regulators allowed SVB Bank to quadruple in size very quickly, which is something that most regulators would slow down your growth. SVB Bank grew, quadruple in size over a 2 or 3 year period, which is incredible. Based on that size, based on their net worth, and based on the uninsured deposits, there's a recipe for disaster. And I think that's what happened here.
Okay. Now, Rich, a question I asked you before. So you work in the credit union sector, right? Now,
Yes.
is this something that you can see happening in the credit union world too, or is this something that's never going to happen?
I'm not going to say it's never going to happen. I just think we are in a different ballpark, right? Most credit unions are consumer-oriented credit unions that cater to the consumer, and their portfolios are diversified. We all have investment portfolios as well. So I agree with Alex. We look at our investments and try to ladder our investments so that you don't have long-term or short-term. You have a little bit of everything in your investment portfolio. We're a lot different from SVB and Signature Bank as well, because we haven't talked about Signature Bank in New York, which focus on crypto, right? The crypto market for the most part. Credit unions, I can just talk about credit unions. Again, we're mainly consumer-oriented, small business-oriented, medium-sized business-oriented. We have a very diversified portfolio of customers and investments. And so I think what happened on Friday, hopefully it's not going to happen in the credit union world. I don't see it happening the way it did on Friday. Since 2008 and 2009, since the Great Recession, the FDIC, NCUA, and the regulators have put in place certain things that have to happen in place, certain ratios, certain tests that each institution has to follow. So we look at that. They look at that every year, and so I don't see it happening in the credit sector as quickly as what happened on Friday.
Okay. Now, Alex, Rich mentioned about the Signature Bank, right? So we all know that Signature Bank is also crashing, right? The fact that it crashed this week, did it have something to do with SVB crashing last week? Is it like a domino effect, or?
I think that part of it was that both have tech companies as their clients. I think it also hurts them that Barney Frank is on the board.
Right.
I mean, way to instill confidence. Like, let's put one of the people responsible for the last crisis in charge of a bank. So they're related, but I think that's the main relation, is that they have tech companies that just all of a sudden decided that they needed to hoard their own capital, especially because with what was happening with SVB, the VCs, the venture capital companies, completely wrongly, by the way, because they have plenty of dry capital, said that they were not going to provide cash for their portfolio companies to get them through. So it puts you in a hoarding cash scenario.
Okay.
Right.
Now, as of the filming of this interview, today is Thursday, right? March 16th. This will air on Sunday, on the 19th. But, today news came out that Credit Suisse, right? They have gotten a guarantee of like $50 billion, right? Now,
Mhm.
does the SVB and the Signature Bank, everything that's happened since last week, does that have an influence into the situation with Credit Suisse?
Oh, absolutely. But not into the actual bank's situation, into the situation of the guarantee. Because anyone in finance will tell you Credit Suisse has been on the verge for years and has been selling off sectors and selling off pieces. They've been in trouble. It's just that what's been going on has created a lack of confidence that could potentially jeopardize depositors' capital if they decided to withdraw all of a sudden,
Right.
which the guarantee is meant to prevent that from happening. But Credit Suisse is very used to getting themselves out of tight corners. They've done it over and over again over the years.
Right. And also, I feel like Credit Suisse is one of those too big to fail type of banks, right? So,
Yeah.
so I think at some point the government is always going to step in to lend a hand, right?
When it comes to the banking side, yes. I remember during the credit crisis years ago, when Deutsche Bank was in trouble, and I was working for a firm that mostly invested in credit, and we were among many managers that moved the custody of their assets out of Deutsche Bank to other banks because we did not feel that the money was safe there until they stabilized. So this isn't exactly new. It's the level, and that it's actually, the fail is actually happening, and then the response.
Okay. Now, this will be an open question to either one of you or both of you. But so for the SVB crisis, who is to blame? The blame should be laid at whose feet?
Ladies first.
Honestly, it goes around. It goes to the Fed. It goes to the current administration. It goes to, honestly, venture capital firms, as well as the actual companies. There is very much the belief that those companies that tried to pull their full bank balances all of a sudden created more of a crisis for those that kept their money in.
Yeah.
It's, yes, there were liquidity issues, but it's not as if there was no value in the investments that the bank had. It was just that there was a certain portion of your account that it was going to take more time to get back. And if you're demanding it right now, you're likely only going to get about 85% or so of your value. No one has actually done the calculations. These decisions were made without anyone doing the calculations on what percentage of depositor capital could actually be immediately withdrawn.
Yeah. I agree. I agree.
Yeah.
I agree with Alex. I agree with Alex. I think that there's a lot of blame to go around. I think, the board of directors of SVB, that's one part of it. Management at SVB, at Signature Bank as well. I think, SVB grew, like I mentioned before, SVB grew quadrupled in size in less than 3 years. That's incredible, as far as growth is concerned. And the regulators, I don't know what happened here as far as that's concerned. So I agree with Alex. I agree with Alex. There's a lot of blame to go around. But then again, the government came in and they're not calling it a bailout, right? It's not a bailout. They're guaranteeing all the deposits, $100 for dollar. So they're trying to calm the markets. They're trying to calm the banking system. and I think it's having that effect, calming everybody.
Mhm.
But I think there's management out there that making bad decisions, investment decisions. So I think, like Alex said, I think there's enough blame to go around to a lot of different groups.
Okay. So this is pretty much just a case of like financial malpractice, right? And it's not necessarily a case of like, criminality or fraud or any sort
No.
of illicit element to it.
When you get
Yeah.
to the illicit element, you get to the fact that most of the executives sold off a decent amount of their stock, which, by the way, is publicly like posted leading up to this. So there's that.
Right.
But
So they basically they knew something bad was about to go down, and they sold off their stock prior to the quote unquote hitting the fan, right?
Yes. They did not technically commit criminal acts, in that it's not as if they warned a bunch of people, but it's definitely ethically questionable, the selling off. Here's the part where I have a disagreement with some other people. How is a bank that's deposits are 90% uninsured, but are pulling from an insurance policy that is paid into by every other bank, most of which are 90% insured, but they're getting 100% coverage?
Mm-hmm.
It's not a bailout in the strictest term, but it basically is, because there is going to be an effect on banking fees for individuals in the future, because other banks are going to have to continue paying in and kind of replenish the policy of this insurance organization. The other really hard part is, with the amount of dry powder in venture capital and the percentage of companies that were with SVB that have venture capital backing, it could have failed. And these companies could have kept on. The venture capital could have helped them with their short-term capital needs. And over time, it would have worked out. And I am sure that they would have been made almost completely whole. And it would have proven out that this wasn't, in fact, a systemically important bank, which they all of a sudden recategorized it, and that there are standards in the banking sector. So, honestly, to me, when you think about it, there is all of this money coming out of the FDIC that is not going to be there to insure other depositors in the short term at other banks.
Right.
And that's a concern.
So other people get the short end of the stick then, right?
Yes.
So you were saying that in your mind, this SVB crisis could have fixed itself, right? It could have been ironed out. So why all the hoopla?
Because there are quite a few high-profile people whose money is in there. Rumors that like Prince Harry has a bunch of his money in there. There are definitely a bunch of huge DNC donors in tech that have their money there. This was a political move. It was not an actual capital markets move, because you could have reinstilled confidence just by actually doing all of the numbers and saying, this is what the actual fallout is going to be. It's not going to affect you. We are keeping the FDIC intact and ready to meet any needs if there happen to be any other failures in the banking sector.
So basically, to sum it up, this is not really a financial crisis. It's a political crisis for one particular party. I think I read an article somewhere where a former CEO of some company was saying that part of the reason this happened is because a lot of the banks and institutions today are too focused on being woke and not focused enough on running a bank or on running a business. Do you think that also has something to play into this, Alex?
So I think that in any corporation, it's a contributing factor to their success. I mostly think that it is a distraction thrown in there because they don't want you to actually look at Fed policy and what's going on with the Treasury, and that this might be a push towards forcing CBDC on people and having a regulated source of cryptocurrency instead of the dollar and instead of banks, taking government control of banks, all of those things. It's a distraction in the workplace, but let's be honest, it doesn't make a difference as far as what your capital retention policy is as a bank. It doesn't make a difference as far as what the policy is for the amount of risk that you're allowed to take with the rest of your portfolio. The regulators totally missed the ball on this. The Fed messed it up. SVB took giant risks that they shouldn't have. Again, plenty of blame to go around. And yeah, does DEI not make it better? Absolutely. But is it the reason? No, that's a cop-out.
Yeah, I agree. I think this bank just had a portfolio that was, like any business, you have, it was diversified. It's one giant market, and there was venture capitalist market. And if that goes under, there's a problem there. The whole bank's going. It's a house of cards. It's all going to go down, right? And quietly, it wasn't as big fanfare. Signature Bank quietly on Sunday night closed down. They just kind of threw it in there, in the news. They just kind of threw it in there. SVB Bank is closing, but then at the same time, Signature Bank is closing.
Yep. SVB is collapsing. Oh, and by the way, so is Signature Bank. Now, Rich, let me ask you: do you see any similarities to what's going on right now versus let's say the 2007, the 2008 subprime mortgage crisis? Is there any similarities, or is it completely different?
No, this is completely different. I believe it's completely different. The crisis in 2008, 2009, it was a combination of real estate, bad loans, bad underwriting, bad real estate, making bad loans, banks making bad loans to individuals who couldn't afford mortgages, who couldn't afford to pay them. You have people buying houses, investors buying 2 and 3 houses. You have people flipping houses that they couldn't afford to begin with. You have brokers. Everybody's hand was the cookie jar. Everybody's hand was the cookie jar.
Well, kind of like what's going on now too, right? So I mean,
no, but now there's more policies. There's more real guards in place in the financial sector. And there's more stress testing on banks, especially in particular the big banks. Big banks have to go through a lot of stress testing. This is why I'm a little taken back that Silicon Valley Bank went from like $40 billion 3 years ago to 200 billion plus in 2.5 years. That's unheard of. That's really, really unbelievable.
Right.
And the safeguards that were put in place, the guardrails that were put in place, really were not. They weren't there. The regulators. I don't know what happened.
Well,
I mean, I know when we get looked at. Believe me, I got regulators all over my office looking at financials, looking at our numbers, looking how we did last year, looking how we did stress testing, looking at my investment portfolio, looking at my loans, looking at the diversification of my loans, looking at our underwriting. I don't know what happened here. I don't know what happened.
Well, it's sort of like anything else, right? If there's a law in place, but it doesn't get implemented, or no one prosecutes, right? then the law is useless. And it's kind of like here, it's the same thing, right? Yeah, there are regulations, but if no one's going to enforce them, right, then bad stuff is going to happen. Alex, which bank do you foresee as the next bank to kind of collapse in the wake of all this?
My hope is none, to be honest. And if one does, it's honestly going to be out of panic, which right now is in the hands of the media, people speaking out, politicians. I read something that said that this is as of like yesterday or the day before, Bank of America saw 15 billion in additional like new deposits, just believing that it was safer. But the fact is that all banks have certain exposure to things like long-term government bonds that are not doing well right now. That doesn't mean they're not going to over time. It's just no bank can survive 50% of their clients asking for all of their money immediately. It's not the way that they're designed. And it was a regulatory failure, especially with the fact that they're not wanting to call out government bonds as being a risk when they are. But I saw something that said that people were questioning the auditor and like, what was their culpability? They audit the financial statements. They don't sign off on the liquidity of the bank. That's the regulator's job. That is not the job of the auditor. So there's plenty of kind of attempts at misdirection. So
it kind of looks like they're trying to find a patsy, right?
Yeah, there is plenty of trying to do that. So as long as banks are transparent and communicate consistently with their clients, I don't believe that there's any need for another bank run, and a bank run would be the cause of another bank collapse. It would not collapse on its own.
Okay. Well, it seems like a lot of this stuff is happening like all at once, right? Like a couple of months ago, we had the FTX crisis, right? And now with the SVB and then the signature, and who knows which other shoe is going to drop, right?
I think it just shows you that that as a depositor at any institution, that you should ask questions of your management. You should get copies of your financial statements. You should question those financial statements. If you're an investor, as well. At the end of the day, you want to ensure that you hold people accountable for where your money's at. At the end of the day, we do. I mean, I get my members call me all the time. How we're doing this week. Again, I think Alex is correct. I think the panic has slowed down. People need to understand that there's faith in the government. The government has done everything they could to put faith in the banking system. They're ensuring these deposits dollar for dollar. They set up a new program. The bank. I forget what it's called. It's an acronym for it, where banks can borrow money if they wish, if they need to borrow money from this new program at 100% at government treasuries, even though the government treasuries are being discounted right now, right? And I saw that J.P. Morgan Chase and a couple of banks got together and they gave a $70 billion line of credit. I think it was to First Republic Bank, and so they're all getting together. They're all getting together to ensure that the banking system is strong. And I can assure you, there's no other banking system in the world better than us. So we're going to be fine. We're going to be fine.
Okay, now Alex, one last question. At this point in time, would you rather put your money in a bank, in crypto, or in your sock drawer?
I would say a combination of a bank and my sock drawer.
Okay.
And actually,
about-
I'd make it two banks. You know, I think that there's something to be said for knowing the 250,000 limit on the insurance, and go ahead and have your money in more than one bank, because it's by account, not by individual. And it has to be with separate banks, but you can go ahead and spread that across and keep your money insured. Same as companies shouldn't concentrate their risk and have all of their money in a single bank. It's kind of common sense.
Okay. Now, Rich, what about you? Are you going to tell us to put all our money in your credit union?
I would agree. You should put your money at United Cities Credit Union, fully insured, well managed, well capitalized institution. But the reality is, I agree with Alex. You know, your deposits are insured up to $250,000 per account. So if you're married, you know, you can have your account run up to $250. Your wife can have her account up to $250, and then together you have another account up to $250. So
Right.
you know, there's ways to make sure you cover your dollars there. But I agree, you shouldn't put all your money in one place, but always protect yourself and always ask those questions. Always ask questions.
Yep. Always ask questions, especially when it comes to your money, right?
Yes.
All right. Thank you, guys, Rich and Alex, for this informative discussion on SVB and on the banking sector, right? And I hope this has been a informative session for all our viewers and listeners. Thank you for your time, and we hope to have you on real soon again, okay? Thank you.
Thank you, guys.
Thank you,
guys.
Ron.
Thanks for watching and listening to Real Talk with Ronnie. To watch and learn more about our show, including ways to contact us and how you can be a guest, go to realtalkronnie.com.